Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Going out a little bit longer in time, it shifts that cost of the spread becomes much smaller compared to the value of the position or the potential value of the position. And I have a specific example that I want to go after here in just a second, where I'm looking at some longer-term options as a way to take a limited risk bet on the market and betting not only on maybe directional positions, but even non-directional trades that are still fixed risk. Okay, so let me. I'm going to drop the franc here for just a minute. I'm going to shift back to YUK. YUK, this is the yen versus the dollar, and I like this one, like I mentioned before, because the quote here in the options it looks exactly the same as the quote in the spot. So it's very familiar to Forex traders. So whether you're tiptoeing, dipping your toe into the FX market, the spot FX market, or whether you're tiptoeing and dipping your toe into using FX options, this is a good one to start analyzing because it looks so similar. So what's going on right now is that I mentioned before that the Fed has they've extended their credit or their currency swaps with other central banks. And the Japanese central bank, the Bank of Japan, came out on Thursday and said that they're doing some. They were a little vague, but they said they're doing some things as well to make sure that they're providing enough dollars to keep everything liquid and moving in the economy. And with the message from that, by the way, so on the 4th, the Fed says, hey, we're going to be sending more dollars internationally, and we're going to be sending them out there for longer periods of time. And then this last week and then yesterday, again, when the minutes came out, the Bank of Japan is saying essentially the same thing. We're going to be using as many dollars as we need to. And what that says to traders out there is, well, okay, regardless of what's going on in the currency market, there's a little bit of demand out there for dollars, and inherently that's going to cost them yen. So they're going to be selling yen and buying dollars. And that shifts this little balance here, which is one of the reasons why we're seeing such a big rally on the yen. So if we go all the way back to the 4th, here's the 4th right there. If you can see where my cursor is at about 89, that was when the Fed came out and said, hey, by the way, we're going to be extending these credit swaps with other central banks. And although they were a little vague about what the decision would be from the Japanese, everybody knew they were going to take it as well. So right on the 4th, we see a bottom in the market where, boom, the dollar starts to gain against a yen, who is, I think, arguably a little bit weak. Now, so this presents an interesting opportunity here because we could look at this from the perspective of probably two things. We could say, all right, well, the only thing I'm really confident about is that there may be a mild bias in favor of the dollar. But the only thing I'm really confident about is that there's going to be a lot of volatility. And there already has been a lot of volatility. But the yen has a history, or recent past history, of real violent swings. I mean, look at this one you can see this in October. You can see this big rally in December. Again, a major reversal in January. And on and on and on. The volatility has been really high. So do I take a long position on the dollar yen in the spot market and set a stop loss? I mean, that's one way to limit my risk, right? Or do I get a little bit more creative and use options in the same way that I might be looking at taking a spot position? So I would approach this from one of two directions. I'm going to go back to the trade tab, and I'm going to type in my symbol here for the ISE options. I got YUK. And it's bringing me up a chain sheet, and it defaults to the front month. So I've got the March chain sheet here. I know that right now the spot is at about 96.65 or so. So we're 96.50 strike price is about the at the money. And one of the ways I can approach this, of course, is just buy an outright long call position. So if I think that the market's really going to go up, well, I know how much it's going to cost me to get into that position, 234. Or I could take a position that I'm trying to leverage a little bit of volatility. So rather than making a bet that the market's just going to continue going up, I could say, well, there's still a probability every time we think that the dollar is going to really gain against the yen, it's been reversing the last several months. So maybe this is another fake out, and I could take simultaneous long and short positions. Now, in the Forex, spot traders sometimes call this a hedge position, where they'll actually take an outright short position and an outright long position. The only problem is that it nets itself out to zero. And the reason why some traders do that is that they figure, well, once the market really starts to take off, I'll kill the losing position, and I'll just let the winning position run, and then you're already in. You don't have to worry about getting a fill. But unfortunately, it rarely works out very well. However, in options, if you're anticipating a lot of volatility, it's a little bit more reasonable. So, options traders are really familiar with taking straddles, for example, where there are two outright long positions, both a call and a put. And there's the reason why I really appreciated Jose's question about the spread, which increases the cost of the trade. It's just one of the functions there. It's going to increase the cost of the trade, is because I think that there are two ways to look at this. We can look at this in March, where we've got, if we were to look at the total here, we're probably going to wind up, we would probably wind up having to pay about $4 to get into this position. If you're a spot trader, that means that we'd have to see if we were planning on holding this all the way through expiration, we would have to see 400 pips above or below the current price on the yen. So if we go up, we're going to be in the 100 range, right there. Well, 164. Let me move my. So if I were trying to visualize this trade, I'm a very visual trader. I know a lot of folks out there are similar to me. So I always try to graph out my positions. What does it look like? How reasonable do I think that looks? Just eyeballing it. So if I got to have the price here on the YUK, if I were anticipating holding this all the way through until the expiration in March, it's got to move to one distance or the other. Now, that seems a little sketchy. Of course, my comeback for traders who always look at that and they think, well, that looks really expensive. I don't think there's any way the market could go beyond that. I would say, well, you could always sell the straddle. Or we could look at this from a different perspective. So the yen is not. I find that oftentimes active traders, they get kind of this vision of, I'm only going to be forecasting over the near term, so only the front month or maybe 60 days at the most. I'm not going to try to look out any further beyond that. But if you're a technician, you know that time value is irrelevant. And from a fundamentals perspective, most fundamentals take forever to kind of work themselves out anyway. So I think a longer-term perspective is probably going to be a lot more productive from an analytical position. And I would argue that using FX options that have a longer expiration have some of the benefits of reducing that cost of the spread when you look at the total value of the position. So let me give you an example here. Let's say that we were going all the way out. I'm back on my cheat sheet. I'm looking at YUK again, which is the ISE option for it's the ISE options for the dollar yen, and I'm going to go all the way out here to December's expiration. So I've got December's expiration, and I'm looking at we got 96. So I'm just going to round up to the 96 strike price. Now we still have a wide spread, but we've got a much higher value, and the percentage in percentage terms, that spread as compared to the amount invested, as well as the upside potential with anticipating a much larger move in the Forex, it becomes less of an issue than it is on the short term. You have that disadvantage that costs of any kind, including spread costs, is less of an issue in the longer term. So, and I think that there's one thing that most options traders I think are pretty familiar with, and if you're not a real active options trader, you may not know this, but arguably you could say that long-term options are inherently underpriced when compared to short-term options.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.